Welcome to Trader TV, your insight into trading for professional investors. I'm Dan Barnes. Joining me today is Eric Vanraes, Portfolio Manager of the Strategic Bond Opportunities Fund and Head of Fixed Income Investment at Banque Eric Sturdza. Eric, welcome back to the show.
Thank you, Dan.
We'd like to discuss today what was happening in the rates markets in the start of Q2. First of all, what sort of factors were affecting rates markets in that period?
The first issue was inflation and inflation fears. The second issue was the behavior of central banks, and first and foremost in the US, because we saw many people talking about tapering. So inflation fears were a little bit exaggerated because the central banks said, and a lot of fund managers said, that it's only temporary. But the figures were impressive, and inflation fears are still a concern because nobody knows. The solution for the problem is higher wages. And we know that, unfortunately, higher wages are unlikely. But in the US, the administration, Joe Biden and Janet Yellen, send a lot of money to American people, to individuals. So these huge amounts of money replaced increases of wages. So the big question mark today is the Biden-Yellen plan still in place? Will they still give money to people? And this could generate inflation pressures, or is it enough? And if it is enough, inflation will slow down and go back to former levels. At the end of the day, the Fed will be obliged to decrease its asset purchases. But they are so afraid of the last taper tantrum in 2013 that they are very, very cautious. And I think maybe the best moment to prepare the markets for this event is the next meeting in Jackson Hole this summer. Conclusion, it means that the slope of the curves in the US and in Europe started to steepen.
And what effect has that had then on European bond portfolios?
It's a very difficult period because government bonds are not attractive and you can lose money with high duration due to the steeper slope of the curve. And very high quality credits are unattractive because the spreads are so low that at the end of the day, they behave like a proxy of government bonds. And on the other side of the universe, high yield is becoming a bit dangerous because spreads are too tight for the risk you take. And the correlation with equities is very high. And we cannot exclude a correction in equity markets in the coming weeks or months.
So what sort of challenges then does that create in terms of portfolio management and management of liquidity?
It's a very difficult question because there is liquidity in markets, but it depends on asset classes because you have only one big buyer, is the central bank, and the market maker is the central bank. And it affects the secondary market, but also the primary market. Because when you see a new issue, it's probably bought at 60, 70%, maybe 100% for a few new issues by the central banks. So there is a distortion in the game and nobody understands very well what is the liquidity. In our view, liquidity is not an issue. But if you want to find a specific bond, sometimes it's very difficult.
So how could asset managers then ensure that they were getting best execution for their investors and optimizing returns as well?
Best execution is not a concern. We are all MiFID compliant and UCITS funds. Delivering returns, we developed two different strategies. The first strategy, as I said before, is that high yield is dangerous, but at the same time, there is a market that is not very well known. It's hybrid corporates. Non-financial hybrid corporates, excluding the banking sector, because you buy subordinated debt, so rated BBB, but subordinated debt of very high quality corporates with an investment grade senior rating. We think that it's a smart way to have return with high quality. And normally, the higher the return, the higher the risk, normally. So hybrid corporates are probably a solution. Second strategy spreads are very tight, but short-term duration spreads are tighter than long-term because the slope of the curve of spreads is steep. So the idea is when you have a corporate that you like, instead of buying the 3, 4, 5-year maturity, you buy a longer maturity, a 10-year bond. But when you buy the 10-year bond, of course, you have higher duration. So you make kind of a synthetic 5-year corporate bond, buying the 10-year corporate, but hedging half of its duration through a short position in futures, Bund in Europe and treasuries in the US. So you decrease the overall duration, but you keep the spread duration of the long duration of the corporate.
It's fantastic. Eric, thank you so much.
Thank you, Dan.
I'd like to thank Eric for his insights today, and of course you for watching. To catch up on our other shows or to subscribe to our newsletter, go to tradertv.net.